Ronald Read was a janitor. He died with $8 million. He didn't have a strategy. He had a habit, and, well, that's why it worked.
It really is an incredible story.
It is, and welcome to the deep dive. Our mission today is to pull out the most critical insights from a really fascinating stack of sources. We've got Morgan Housel's The Psychology of Money. We're looking at Yale University endowment strategies, John Bogle's theories on investment expenses, and even some hard industry data on robo-advisors.
Yeah, it's a huge mix of data, but it all points to one thing.
Right. The core argument here, the angle we're exploring, is that most real wealth is built completely by accident. It's just time, really boring assets, and, simply not interfering.
Exactly. The contrarian thesis here is that optimization is basically the enemy of compounding.
Yeah.
If you can hear yourself thinking about your portfolio, you are probably hurting it. The richest people, historically, are usually the ones who completely forgot they were even investing.
Which brings us right back to Ronald Read, because his life, he was a gas station attendant and a JCPenney janitor up in Vermont.
Just a completely normal working-class guy.
Exactly. He drove this old, beat-up Toyota Yaris. He literally held his denim jacket together with safety pins. But when he died, he left behind an $8 million fortune. He gave $6 million to his local library and $2 million to a hospital.
Just an unbelievable legacy.
And his quote-unquote strategy was literally just buying blue-chip stocks, like Procter & Gamble, Wells Fargo, and holding them for decades, just reinvesting the dividends. But okay, let's unpack this because I have to push back a little here. Was Ronald Read actually a financial genius, or did he just get incredibly lucky by investing in a much simpler era?
That's a fair question.
Right. Because looking at the source data, Wells Fargo went from 96 cents in 1972 to $60. P&G went from 22 cents in 1962 to $60. And back then, dividends were, 40% of historical returns? Today, they're like 16%.
Yeah, the landscape has definitely shifted. But what's fascinating here is that his core advantage actually wasn't his stock picking.
It was.
No, not at all. It was his survival. The dividends helped, sure, but the underlying engine of his wealth is just compounding. And compounding doesn't require tremendous force. It just requires a small base and, honestly, an absurdly long amount of time.
Just a really long runway.
Exactly. Look at the sources on Warren Buffett. Of his $84.5 billion net worth, do you know how much that came after his 65th birthday?
I know it's a lot, but...
That's $81.5 billion.
Wait, really? $81 billion after age 65?
Yeah. The vast majority of his wealth came when he was officially retirement age. That is the nature of compounding.
Wow. Okay, so if a janitor can accidentally make millions just by waiting, why do highly educated professionals like Wall Street guys actively fail to do this?
Because they can't afford to do nothing.
Right. We've got the data from Yale CIO David Swensen right here. It says 78 to 95% of actively managed mutual funds fail to beat the market. 95%.
It's staggering. But you have to look at the historical examples to see why active management underperforms the passive accident.
Okay, lay it out for me.
Take the 1987 stock market crash, Black Monday. U.S. stocks fell 23% in a single day.
Just a total bloodbath.
Exactly. Now, imagine you're an active mutual fund manager during that day. You might know, rationally, that it's a panic and you should hold. But your clients are calling, completely freaking out, demanding their cash.
So you literally have to sell.
Right. You're forced to sell at the absolute worst time just to meet redemption requests. During these events, active managers try to outsmart the market, trading frequently, and they just generate huge fees and taxes.
Which ties perfectly into John Bogle's theories, right? The cost matters hypothesis.
Yes, Bogle nailed this. Compounding interest builds your wealth, but compounding costs completely destroy it. Active management is basically a loser's game.
Where winning just means making the fewest mistakes.
Exactly.
It's kind of like being stuck in a massive traffic jam.
Oh, I love that analogy.
Right. You're sitting there completely stalled and the lane next to you starts inching forward, so you aggressively merge over.
Naturally.
But the second you get into that lane, it stops dead, and the lane you just left starts moving. So you keep switching lanes, trying to optimize your position, only to realize that all the lane changing just burned more gas, which are your fees, and left you way further behind the guy who just stayed put in the slow lane.
That is exactly what happens. And this shifts the conversation from Wall Street pros to everyday investors, too.
Right, because we're doing the exact same thing on our phones.
We are. The behavioral gap is very real.
And here's where it gets really interesting. The sources highlight this Betterment study on self-directed investors. They found that everyday people who tweaked their asset allocations suffered a behavioral gap of negative 41 basis points.
Right, compared to the people who just left it completely alone.
Exactly. The more they touched it, the more it cost them. It's the touch the portfolio tax.
Which is just brutal. And this raises an important question. Why do we feel the need to touch it?
I mean, human nature.
Totally. Humans are emotional creatures. We are not spreadsheets. When people monitor their portfolios all the time, their emotional time horizon shrinks dramatically.
They zoom way too far in.
Right. They start viewing normal market volatility as a fine for doing something wrong, rather than just the fee you pay for long-term growth.
Oh, a fine versus a fee. That's a great way to frame it.
Yeah. I mean, look back at the 2008 global financial meltdown. U.S. stocks dropped 57% from peak to trough.
Terrifying.
If you were constantly checking your balance back then, you were psychologically wiped out. People couldn't handle the pain, so they sold at the absolute bottom.
Paying the ultimate touch the portfolio tax.
Precisely. They paid the tax and missed the entire recovery.
Okay, so the obvious solution is to cultivate this quote-unquote do-nothing superpower. We need to embrace the idea that being reasonable is better than being strictly rational.
Yes, reasonable over rational.
But let me push back on this, because it sounds good in theory, but look at the world. If the world is just filled with unprecedented disasters, isn't doing nothing incredibly irresponsible?
It feels that way, absolutely.
I mean, the sources literally map out this cascading, unpredictable nature of history. You have the 9/11 attacks, which prompted interest rate cuts.
Right.
And those cuts led directly to the housing bubble, which gave us the 2008 crash, which then pushed everyone into graduate school and gave us the current student loan debt crisis. It's just one crisis triggering the next. So in that environment, how is doing nothing the right move?
Well, it's actually because the future is completely unpredictable that hyper-rational optimization makes you more fragile.
Okay, explain that.
Let's look at this academic study from the sources. It suggests that young people should actually use 2-to-1 leverage to maximize their returns in the market.
Meaning they borrow money to invest.
Right. Now, on paper, mathematically, that is perfectly rational. It maximizes lifetime returns.
Sure, in a spreadsheet.
But entirely unreasonable for human sleep patterns. Think about the 2020 COVID crash. The market fell off a cliff in weeks. If you were leveraged 2-to-1, you got wiped out. You got a margin call and lost everything.
Oh, man. Yeah.
So to survive volatile markets, you really need what the sources call a barbell personality.
A barbell personality, like weights at the gym.
Exactly. On one end of the barbell, you have to be highly optimistic about the long-term future. You believe the market will go up over decades.
Why?
But on the exact opposite end, you need to be extremely paranoid about short-term risks.
So having a massive cash buffer.
Yes. Ensuring you have enough room for error, like deep cash reserves, so you are never ever forced to sell during a panic to pay your rent.
Even if holding cash is mathematically suboptimal because of inflation.
Exactly, because surviving the short term is the only way you get to experience the long-term compounding.
Wow. Okay, I want to shift gears slightly because the deep dive gets into the psychology of why we invest in the first place. And this part really blew my mind. The man in the car paradox.
Oh, this is one of my favorite concepts.
It's so true. It says when you see someone driving a $100,000 Ferrari, you don't actually admire the driver. You just imagine how much people would admire you if you had that car.
Yes. If we connect this to the bigger picture, it explains the absolute paradox of wealth. People buy these luxury goods to gain respect from others.
Right.
But the irony is, humility and empathy actually generate far more respect than the car does. People aren't respecting the driver. They're just projecting their own desires onto the car.
So we fundamentally confuse being rich with being wealthy.
We do. They're totally different things. Being rich just means you have high current income. It means you can afford the monthly payment on the Ferrari.
Yeah.
But wealth is what you don't see.
It's the invisible stuff.
Exactly. It's the cars you didn't buy.
Yeah.
The first-class upgrades you declined. The money sitting quietly in a Vanguard fund. Untouched.
So what does this all mean for you listening? It means money's greatest intrinsic value isn't buying stuff. It's buying control over your time.
That is the ultimate goal.
True wealth is having the flexibility to, take a lower paying job that you actually love, or just the ability to wait out a bad economy without panicking.
Time and autonomy. That's what wealth really is.
Absolutely. So just to recap the journey we've been on today. We started with Ronald Reagan's Accidental Millions, just holding blue chips and sweeping floors.
The ultimate proof of concept.
Right. Then we looked at the structural failure of active management, the hidden touch the portfolio tax that destroys our returns, and finally, this realization that real wealth is just unspent options.
It really reframes everything, doesn't it?
It totally does. Which leads me to a direct challenge for you, the listener. Seriously, try this. Don't check your portfolio for 30 days.
Not even once.
Not once. But write down the urges you have to tweak it. Whenever you want to move some money around, write down what you would have done. And then, later, calculate what that interference would have cost you in fees or lost gains.
I love that challenge. It really quantifies the behavioral gap. And I'll just leave you with a final thought to mull over while you're doing that challenge.
Yeah.
The pursuit of visible status is the silent killer of invisible wealth.
Oof. That is incredibly well said.
Thank you. It's tough to internalize, but it's true.
It is. And it's actually the perfect segue because next time we're doing a deep dive into status versus wealth. It is arguably the most expensive trade-off in modern life.
It's going to be a good one.
We're going to break down exactly why someone earning $200,000 a year can feel entirely broke while an $80,000 earner feels incredibly rich. You really won't want to miss it. Catch you next time.